usually when people look to buy a house, they think they only need to come up with the down payment. Well, I'm here today to tell you that is not the case. There's actually a second pot of money, closing costs and prepaid expenses that the buyer is responsible for. My name's Aaron Benton. I'm host of this channel and a local mortgage lender in Bluffton, South Carolina. Stick around because today we're going to talk about the second pot of money, closing costs and prepaid expenses. And at the very end, I'm going to talk to you about a strategy so that you can limit that upfront cash to close. So stick around because we're going to get after it right now. So that first pot of money is down payment. That would be the principal portion, your equity stake or equity share in the house when you purchase. So you got your down payment. Now the second pot of money begins with closing costs, and you're going to have mortgage related costs. You're also going to have attorney related costs if you are in an attorney state, or you could have title fees depending on the state you're in. And then there's these prepaid expenses. But right now I'm going to focus just on the mortgage related costs. So do you have a mortgage banker and a mortgage broker? You could see an origination fee, an application fee, underwriting fee, processing fee. You're going to see an appraisal. You're going to see a flood certification, a credit report, a tax service fee. Those are the kind of things you would see from a mortgage banker. So those are all just the fees to get you from start to finish. Origination fee is going to be somewhere in the $1,700 to $2,100 range. Again, that's an upfront cost. Appraisal will be somewhere in the $500 to $725 range, depending on the value of the home, depending on whether it's a primary home or an investment property. If it's an investment property, the appraiser needs to go and complete what's called a rent schedule, in which case not only are they assessing the value of the house, the purchase price and what you're buying it for, but they're also looking at how much can the property rent for on a monthly basis. So there would be a charge for that additional rent schedule. Then, like I said, you have the credit report, the tax service fee, the flood cert, and maybe some other miscellaneous fees. Now, you might also see points. Points is an upfront cost that people will pay, and in exchange for that upfront cost, you get a lower interest rate. So think of it as pay me now or pay me later. If you upfront pay the points, then you are going to save on a monthly basis by having a lower interest rate. It's kind of pay me now, and in turn, you will have a lower interest rate for the life of the loan. Rather, you could also take the standard rate, market rate, and you don't have to pay points. So points are completely optional. The other fee that you gotta look out for is a broker fee. Some brokers will charge you, not only do you have your normal standard origination fee, processing fee, but they might also charge you a broker fee, which is really a finder's fee. They went out, they kind of searched for best interest rate in the market. They were charging you a fee to essentially find that rate and then execute your loan. A mortgage broker does not actually fund your loan. It is the lender that they find. Whereas if you were to go with a mortgage banker, then the bank is going to fund the loan with their money. They very well might transfer that loan to one of their servicers after closing, but mortgage broker, it's not going to be their money. It will be the lender that they utilize, and you would get disclosures and it would describe to you who that lender would be. And of course, if you're working with a banker, then it will be the bank's money that is going to fund your loan at the table. And again, they might transfer the loan after the fact or after closing, but something to just be on the lookout for is there going to be a broker fee or not? A lot of people will shop interest rates, and it's very important to ask, hey, is there a broker fee associated with this? So those are mortgage related costs. Depending on the state, you're either going to have an attorney related cost or title related costs. South Carolina is an attorney state, and what that means is that you need to have attorney representation, legal representation throughout any kind of real estate transaction. So whether you're purchasing or whether you're refinancing, you would have an attorney that would be able to assist you. Now they're going to charge you a settlement agent fee, and that's going to be their cost to get you from start to finish. They're going to charge you maybe an abstract fee, maybe a wire transfer fee. There's a slew of costs that they could potentially charge. And an attorney fee to get you from start to finish, anywhere in the realm of maybe $1,750 all the way up until probably $2,500. In terms of, again, these are just estimates. I'm not an attorney, so it's pretty hard for me to quote their fees. That is generally in the Lowcountry of South Carolina. You're going to be in that $1,700 to $2,500 cost to do business, if you will. cost. Then you have what's called title insurance. And title insurance, it's just like any other insurance. It's a one-time fee up front, and you hope never to have to tap into it. But if you do, then you'll tap into this title insurance. You'll reach out to your attorney. You had an issue with title post-closing, and that's exactly why you would get title insurance. The exact description of what title insurance gets you, I would defer to an attorney because it is truly an attorney fee. I, as the lender, can tell you, you do need lender's title insurance to cover the bank up to your loan amount, and then owner's title insurance is optional, but in terms of what everything gets you, that is really an attorney piece that I would advise you to talk to. The third pot of money, so we've covered down payment, that's your principal interest in the property. We have your closing costs, mortgage-related costs, attorney or title state, so title-related costs. Then you're gonna have these prepaid expenses. Well, prepaid expenses is essentially your money. So you're gonna collect the first year of insurance at closing. Even if you were to escrow or not, we're still going to collect the first year of insurance at closing. So let's just hypothetically say that your annual insurance is $3,000 a year. We would collect $3,000 up front, and then we will collect 2 to 3 months of insurance escrow if you were escrowing, and that's going to be a cushion. So understand, if you were to close in April, we'll just say April 15th you close, your first mortgage payment is not going to be due until June 1st. That's right, you don't have a May 1st mortgage payment. Now, in that piece, understand that we are going to collect insurance every single month, and we're going to pull from that piggy bank. I think of an escrow account as a piggy bank, and really, it is a piggy bank that only holds tax and insurance money. You will fund it on a monthly basis with tax and insurance money. The bank will collect 1/12 of your insurance, 1/12 of your taxes every single month. Once they have 12/12, the bill is due, and they pay the bill on your behalf. So 2 to 3 months worth of insurance escrow, and then taxes. Should you escrow, that is going to be a sliding scale. Now in South Carolina, taxes are only billed once a year. They come out in October at the end of the year. They're due basically in January of the following year. They're always paid in arrears. So in 2026, taxes for 2026 would be paid by January 15th of 2027. Depending on the month that you close, your tax escrow could range anywhere from collecting 2 months all the way up to 13 months, depending on that time of the year. Now understand, if you were to close on a property, say December 15th, yes, we're gonna collect 13 months of taxes, but recognize, we know that you did not own that house or live in that house basically the entire year. The seller is going to, at the closing table, they are going to credit you the tax proration that for the period of time that they own the house. So yes, we are collecting a pretty lofty number there, but you're going to get credited back the taxes for the time that the seller owned or lived in the property. So you got your first year of insurance as a prepaid expense, you got a couple months of insurance escrow, you got a couple months of tax escrow. Then you have this, what's called prepaid interest. And that's all gonna be based on the date that you close on. So like I said earlier, if you closed in April and your first mortgage payment's not due until June, let's just say hypothetically you closed April 15th, I'm gonna collect 16 days worth of prepaid interest at the table to get me from April 15th all the way to May 1st, 16 days. And that would essentially that negates the need for that May 1st mortgage payment. So you're gonna have some prepaid interest. Now, in South Carolina or Hilton Head, Bluffton, where I live, there's one other big cost that sometimes trips people up, and that are the neighborhood transfer fee. And that is something where your real estate agent is going to be your best friend, because every neighborhood is different. If you're buying in Hilton Head, maybe it's in Hilton Head Plantation, it's 1/4% of the purchase price. Palmetto Dunes is 1/2 of 1% of the purchase price. Over in Bluffton, you can see 1/4 of 1% of the purchase price. You can also see flat fees. You could see $15,000 up front. You could see $65,000 up front. That was the old field fee in 2026. Please be alert that there is going to potentially be a neighborhood transfer fee. Now, if you buy on the town in Hilton Head, or 1/4 of 1% of the purchase price. That's right, just buying on Hilton Head. all people buying their pay to the town 1/4% of the purchase price. And then in addition to that, they could pay the neighborhood transfer fee. So you got your closing costs, your prepaid expenses, which again, the prepaid expenses are just the taxes and insurance, your little piggy bank. If you were to sell the property one day, whatever is in your escrow account, that money will come back to you. That is not a fee, but rather you are funding that money. And then you have your neighborhood transfer fee. Now, you're probably saying to yourself right now, whoa, I have to come up with the down payment and I have to come up with these closing costs and prepaid expenses. And Aaron is telling you this could be roughly, these closing costs and prepaid expenses could be anywhere from $10,000 all the way up to, we'll just call it $15,000. But if you have a $65,000 neighborhood transfer fee, understand you could be up into the $80,000 range here. So you just want to be alert of that. Now, one of the things to understand is that when negotiating, the seller can pay a portion of your closing costs. So depending on the loan that you are getting, if it is conventional financing, if you are putting anywhere from 3% down as a first-time home buyer, all the way up to 10% down, you could get a credit. Now you're probably thinking, how are we gonna come up with all this money? I thought I had to come with down payment only, and now I'm being told I gotta come up with a down payment. The mortgage-related costs, the attorney-related costs, the prepaid expenses, potentially a neighborhood transfer fee. Boy, do they really add up. I feel for you. And especially for a first-time home buyer, you're thinking, I just wanted to put down the bare minimum. Maybe it was 3% down on a conventional loan, 3.5% on an FHA loan. VA financing, 100%. You weren't even thinking that maybe you could structure your deal and not have to bring any money to closing. Well, I'm here right now to tell you, you can still have it that way. So if you really like that, just type in the little comment section below, closing costs help, and I'll make sure that we can connect because I'm gonna go over this strategy with you here, but I can also talk about your individual situation. So with Fannie Mae, Freddie Mac, conventional loan, it's actually a tiered system. So if you were to put down somewhere in the 3% down range, up to 9.99%, the seller can give you a credit, 3% of the purchase price closing cost credit. Again, it's something that you would negotiate. Now, again, on that sliding scale, if you're to put anywhere from 10% down to 25% down, it would be 6% of the purchase price that the seller can contribute. And if you were to put down greater than 25%, the seller can contribute 9% of the purchase price. Now, recognize, sometimes closing costs and prepaids don't add up to 9% of the purchase price. You can't get any money back. So make sure that is something when we're talking about these negotiations or these structures, the strategy, you want to understand what the closing costs will be because you don't want to over ask. If closing costs are only going to be $15,000, asking for $25,000 in seller paid closing cost credit, you're kind of asking basically what we would do in that situation. We as the lender, I would essentially use the excess money to buy your interest rate down. I would be then having you pay points and then have the seller give you a credit so that I could use that entire credit. But nevertheless, some people don't want to necessarily pay the points. And with that being said, you should make sure that you talk to your lender so that you can understand what the upfront cost will be so that we can ask for a reasonable number so that we can use all of that credit. Now, if you're buying an investment property, it's 2% across the board. Doesn't matter the down payment, 2% across the board based on the purchase price. If it's an FHA loan, it's 6% of the purchase price. And if it's a VA loan, it's 4% above and beyond standard closing costs. That's right, on a VA loan, the seller could actually help pay off your auto loan. They could pay down a credit card. They could do a lot of things in addition to paying those standard closing costs. So you can actually get this exactly how you want. You could have your down payment and you could have the seller pay for your closing costs upfront. They could actually buy your interest rate down too. So if you're thinking, hey, I really only want to come up with the down payment, this is a negotiating strategy. Now, what I like to tell people is remember, you're negotiating. So if you are offering $440,000 and you're going to pay all your closing costs, that is the same offer as $450,000 and the seller is giving you $10,000 in closing cost credit. It is still a net of $440 to the seller. So it's certainly something you want to take into consideration because you don't want to make the seller feel bad or make it feel like you're giving a lowball offer. So keep that in mind, that you are essentially negotiating on closing costs sometimes. And really at that juncture, if you're going to ask for or buy the house at actual list price and have the seller cover closing costs, essentially you're kind of financing your closing costs in it. I really like that strategy because I like people to keep money in their pocket when possible. It's nice to have cash is king, as they say. It's nice to have that money to cover furniture, moving costs, things of that nature. So a really, really powerful strategy. I hope you really liked today's video. Of course, we talked about those upfront costs, down payment, closing costs, prepaid expenses, potentially a neighborhood transfer fee. So whether you're looking to purchase in a week, a month, or even a year, reach out. We'll schedule a call, send me an email. I'd like to understand your situation because together we can make sure that you understand the numbers up front well in advance and build that plan specifically for you so that you can create an offer that best benefits you. I hope one day to get to meet you, but if not, I hope to at least see you on the next video.